This is a free stock market learning center being offered as a public service by our parent company, stocktiming.com. There will be at least 10 free video seminars on how to become a better and smarter investor. This seminar series will be conducted by Marty Chenard, a 35-year veteran of the stock market and the senior technical analyst at stocktiming.com.
Hi, this is Marty Chenard, and I want to welcome you to our Technical Analysis Learning Center. Let's start right in with Seminar number 1. This session will teach you an easy-to-use model that showed a 30% plus gain per year over a 14-year period when gains were reinvested. Here's what we'll cover in this session. Number 1, we'll show you an easy-to-learn model that you can use to accurately tell you when a bull and bear market starts or ends. Number 2, you'll learn how to create your own bull-bear market charts with an exact indicator setting, the same ones that we use. Before we show you the bull-bear model, let's discuss its basic requirements of where to use the model and why. First, indexes that are too small in numbers or have poor representation in multiple economic sectors or represent small cap stocks lack the homogeneity to truly measure the true economic conditions, so you have to use the most homogeneous index. Second, the most homogeneous index is the S&P 500. Institutional investors use the S&P 500 as their best indication and bellwether for the economy, because it has the broadest representation of large cap stocks in multiple sectors. This is important because large institutional investors control well over 50% of all trading volume each day and thereby have the greatest influence and control over the market. Therefore, this model is designed only to be used as a bull-bear indicator on the S&P 500. This is our bull-bear market modeling chart. First, your chart needs to be a monthly chart of the S&P 500. Then, with a monthly chart, you'll be using a set of 5 different indicators. The parameters are set to work together as a group and cross-confirm when we start and end bull and bear markets. Don't worry about the indicator settings for now. We'll tell you what they are later. Let's start by looking at the chart. On the top, we have the price movement of the S&P 500. Notice there's the red and blue line. These are 2 moving averages. They're set for crossovers to give an indication of when we are shifting from a bull to a bear market, from a bear back to a bull, and back down to a bear market. So as we can see, in March 1995 we had a red crossover of the red moving average that lasted until November 30th, 2000, which was the end of that bull market. We don't want to go by one indicator, so we want at least 3 confirming indicators. And for that, we're going to use MACD as our first indicator. And if you notice, in March 1995, we were beginning to get a crossover of the red over the blue line. A close-up would clearly show that the red had gone over. That was the first confirmation. Your second confirmation you look for from a MACD histogram going positive. It went positive by going over the 0 line, and it was very clearly positive at that very same time. The third indication we want is a confirmation of a stochastic oscillator moving to the upside and being above a set of Bollinger Bands, which we'll discuss later. So that was the beginning for 1995. The confirmation that it ended and started a bear market was on November 30th, when we had a red and blue crossover of the moving averages. The MACD had clearly given us a down signal ahead of time, giving us an indication that it would happen. We had a confirmation of the MACD histogram where it was negative, and our third confirmation was the stochastic moved below the lower Bollinger Band, and the low Bollinger Band is the trigger point in both cases. We had a market reversal back in May 3rd of 2003, starting a new bull market. Very clear crossover of the MACD, a very clear positive move on the MACD histogram, and notice down here the stochastic was moving up positive and it just crossed over the lower Bollinger Band. That lasted, as you all know, until January 31st of this year, when we had a confirmation of a bear market. It was further confirmed by the MACD crossing over, our MACD histogram going clearly negative, and look what happened on the stochastic oscillator. It cut through the bottom of the Bollinger Band, and we've been in that bear market since. So how did this model do if you just entered the market and exited it when the bull and bear signals were confirmed? First, you would have only had 4 trades since 1995. There would have been 2 long trades and 2 trades shorting the market. Notice on the chart, on the price chart now, I've labeled them 1, 2, 3, 4. 1 and 3 are the bull market moves, 2 and 4 are the bear market moves. Corresponding to that, there's an Excel matrix here on the right showing the profit on each of those moves over those time periods. As you can see, the first one was over 162%. The bear market move was 26% plus. The next bull market move that we just recently had was 43.06%, and the bear market that just started in January as of the beginning of November would have been over 38%. The total for the 14-year period was 270.70%, or an average yearly profit of 19.34%. Over that same period, if you had reinvested the funds, the average profit would have risen to 32.86% per year less commissions. So now the question is, how do you set the indicators? Well, first, if you look on top, I've got all the indicator settings here. For the moving averages, the red line is a weighted moving average of 6. That's 6 months. The blue line is a simple moving average of 12 months. The MACD indicator is a simple standard setting of 9 exponential. The MACD histogram is a setting of 9 exponential, which is a very standard setting. The stochastic oscillator is a little bit different with a setting of 13, 3, and 3, and with the Bollinger Band being 22 and 2, which is a standard setting. It's that simple, not complex, and all the signals are confirming each other when you use them. That brings me to another topic, drawdowns. Drawdowns are how much your trading account can go into the negative while trading a system or model. This is probably the most unnerving aspect of a trading system because you have to maintain your belief in it no matter what. Let's look at what happened on this particular model. On the first short signal on November 30th, 2000, the market did go down, giving you a profit on the short. However, it continued to go up from there for a 2-month period until January 31st, where you were sitting on a 5.3% loss or a 5.3% drawdown. Sitting it out during the rest of the period obviously would have brought you to terrific profits as the market moved down. The second drawdown example is a short this particular year in January 31st. Your entry point would have been here. Notice you'd have worked your way down, and then for a 2-month period work your way up till May 19th, when your drawdown would have been 4.3%. Sitting over into a position for 2 months is really unnerving when it's going against you. But having the patience to do it had definite profit, as you can see where we ended up in the beginning of November. The message here is that investors need to pick models and systems that match their expectations and their emotional fortitude. Now let's conclude this seminar with the key points to follow. First, use this model to always know for sure if you are in a bull or bear market. Number 2, follow the rules of this model. Use it only on the S&P 500 with the correct indicator settings. And 3, invest with the trend. In bull markets, invest only in long positions. In bear markets, invest only in short positions. Historically, more than 3 out of 4 rally attempts on the major indexes fail within 1 to 7 days during a bear market. So when is your next free seminar? If you enjoyed this seminar and would like to take the rest of them, just sign up for our free notification service. The notification service has only one purpose, and that's to let you know when the next free seminar is posted, so you don't have to keep looking every day to see when the next seminar is available. To sign up for this free alert service, just go to www.stocktiming.net's homepage. Look down on the left and you'll see the Tell Me When button. Just click on it and sign up. It's that simple. Thank you for spending your time with me, and I'll see you on your next free seminar.